The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. I'd like to thank you for joining us once again on our In the Trenches series. Today, you have the regular crew of Craig Nazaro and Brad Rustin. We're talking about something that is becoming more and more important as we're moving forward into 2020. And that is litigation trends that we're seeing in community and regional banks, what we think is going to be coming as we continue to close out Q4 of 2020, what some of the concerns are. And as we look forward to 2021, during today's presentation at any time, feel free to send in your questions or comments using the chat function here in GoToMeeting. We'll try to respond to those in real time as you have issues that you may want to raise that come up. Got great attendance today, and we're going to try to take a fairly broad view of litigation trends. And so we're going to start out talking briefly about some of the consumer challenges. We'll look at a little bit of the trends in terms of what we're seeing within the macroeconomic conditions affecting banks right now and large credit unions. We'll then shift, do some updates on PPP lawsuits, the Paycheck Protection Program lawsuits. There's been some very positive developments there. If you were a lender who was making PPP loans, if you're an accountant who was trying to collect agent fees on PPP loans, you've had a lot of bad news over the last 4 weeks, but we'll talk about some of the updates there. Third, we're going to talk about what I think is going to be one of the most heavily litigated areas as we move into 2021, and that is data breach and cybersecurity lawsuits. We'll talk a little bit about why that's becoming more important as we speak, particularly how some of the adaptations we've made to respond to the COVID pandemic are really driving risk factors for data breach and cybersecurity. And then lastly, we'll talk about a little bit of some of the updates on merger litigation. We'll look at some of the latest data from the FDIC on bank mergers, what we're seeing in terms of trends there, as well as how you're thinking about M&A activity as we move into this, what I would call new normal post-COVID. So a lot of ground to cover today. We'll try to be fairly efficient, but as I say, at any point, if you do have questions that come up you'd like to see covered, feel free to shoot those in. We'll try to respond to them. So we're going to kick it off talking about consumer litigation, and what we're seeing there is largely we're preparing for some repeat of 2007 during the recession. I don't know that it's going to be quite as significant depending on how the relative timing of some of the relief packages, some of the economic stimulus compared to the default cycles here. But really what we're going to talk about here is what we saw in 2007, 2008 in the wake of the recession, and what we can learn there so we don't repeat some of those mistakes. We've had one of the longest sustained periods of economic growth in modern times. And so with that, a lot of individuals within banking organizations and compliance functions have not had to deal with what we saw in 2007, 2008, which was significant defaults that tended to focus on certain areas of your bank's lending portfolio, and how you respond to that to make sure you're not adding too many issues by, for instance, inviting lawsuits or litigation from consumers being impacted. We'll start with a little bit about where are we now. So this is the latest Fed data. It goes through Q2 of 2020 that you see on the screen right now. By the way, for anybody who doesn't use it, the St. Louis Fed is quite possibly the greatest repository of data that's out there. And they maintain huge data sets on economic indices, economic indicators. This is an interesting chart that if you've joined us from the trenches in the past, we've tended to update it as we go along. And what it does is it looks at main loan default lines. And so it's looking at things like lease, consumer loans, credit cards, as well as single family residential mortgages, and then crossing them over to historical data on unemployment. And so if you see that top line with the giant spike in 2020 is obviously the unemployment rate here in the U.S. We got somewhat rough numbers, or at least a little bit worse than expectations this morning. So it has not been updated with the latest figures that came out this morning on unemployment. But what we generally see, if you're looking at macro trends, is that as that unemployment rate spikes, such as what we saw in the late 2000s, with that then comes these tail delinquencies. And so as unemployment increases, you first see a default risk on your credit card portfolios. That tends to be followed by consumer loans such as auto. Then you see consumer unsecured. And then the last to pick up is oftentimes when we're looking then at mortgages tend to be the last to show up. And so when we look at this, we see that there is currently, if you look at the very bottom right corner of that graph, that we actually are seeing a decreasing default rate in a lot of those portfolios. So, unemployment continues to come down from those highs that it hit in the beginning of 2020. But we also see that there continues to be a lower default rate in consumer lines, including, with the exception of lease receivables, continue to go up. And so a lot of people, including our clients, have said, well, why is that? Why are we seeing that trend developing? And one of the things that data set doesn't show, and this is something just to be aware of, is when we talk about delinquency and those that are in financial hardship plans, depending on the line of loans that you're talking about, there's somewhere between 4 and 7.5% of loans that are operating under financial hardship plans. So they're not currently in default. They've got some sort of hardship plan currently in existence. Interestingly, we still can see that dropping each month, which is very good signs for the economy. We just got the latest numbers from TransUnion. They released their August data sets. And so compared to July, we still continue to see a lower default rate every single month, which indicates that things are starting to stabilize somewhat. But candidly, if you look at it compared to 2019 levels, depending on the loan line that we're talking about, default levels are anywhere from 8x to 200x when you're talking about credit card defaults, 200 times higher than what they were at a similar time in 2019. Interestingly, the most significant disparity between 2019 and 2020 in terms of default rates are in super prime and prime credit. Subprime, actually, if you look at it compared to 2019 and compared to earlier in 2020, subprime is holding more steady, and you don't see those high multipliers. One interesting observation is compared to 2019, residential mortgages doing better than this same time in 2019. So, a lot of promising data that's coming out right now. But we still see, if you take these numbers, those loans that are operating under financial hardship plans, and then you add that to what we saw previously on the default rates, the real number of individuals or percentages of portfolios that are either in default or operating under hardship plans with payment deferrals is probably somewhere between 4 and 10%, depending on the portfolio we're looking at. So with that understanding, we expect in the coming quarters, depending especially on what's the results of the election, some of the stimulus efforts or recovery efforts that are currently being proposed in Congress, all may ultimately drive a little bit what we see in terms of the coming 2 quarters. In any event, I think it makes sense, though, for financial institutions right now to really be planning for what happens in a default cycle. If we see defaults continue to rise, if the stimulus and the recovery that's being pushed through governmental funding begins to run out before we get the economy and some of the underlying metrics cleaned up, then we may continue to see one of those default cycles. And so really now is the time to be planning for some of these concerns.
So a way that we plan for these concerns is first taking a high-level view of where the lender liability claims originate from or where we expect them to originate from. And here we want you to realize that it's not just at origination. Most borrower claims, start out with fair lending violations or fair lending concerns during the operations and servicing, default, and collection. So we want to take a look at those operational areas and determine if they're properly staffed, if we can shore up the policies and procedures, what we can do to limit any of the process breaks that will drive litigation as these default rise. So number one there, do you have a formal default process with clearly defined workflows, borrower communications, relief option disclosures? A lot of us, have gotten caught up with the loss mitigation options or the borrower assistance programs at the front end and how that's rolling out, but did we look at it systematically as to how it's being messaged to the employees? Do we have them clearly documented in a workflow or a process chart for the loan level employees that are actually making these options available to your borrowers? You also want to make sure to look at the complaint volumes, look at your default volumes, and see what kind of inquiries are coming in. Do you need to staff those default problems and that default process with a little more employees, just to make sure that you're handling adequately the demand that's coming in? Number two there, do your policies and procedures make clear that fair lending concerns also arise in servicing default and forgiveness? You know, a lot of clients focus fair lending efforts and fair lending controls on the front end originations processes, not necessarily responsible fair banking and fair servicing. You want to make sure that you're servicing default and forgiveness, so have the similar controls. You're looking at the same disparate impact across those operational units, not just the front end. Number three, do you clearly identify and apply eligibility criteria for relief programs and forgiveness? You want to make sure that you know, the exception process is limited for any of the relief programs and forgiveness. That's being applied equally and fairly across your entire borrowing population. Number four, do you train bankers to avoid consulting on the use of funds, the forgiveness applications, and interpretations of laws and regulations? We saw this create a lot of problems in the last downturn, 2008, 9, and 10, when we saw HAMP and HARP roll out. You saw, you know, those people that are trying to help at loan level default teams saying, look, you have to be in default in order to be approved for the program. You have to have this many days delinquency before I can even look at your file. You do not want the loan level employees in your institution giving any kind of advice like that. It just drives liability and will drive your litigation cases in the years to come. Next slide, Brad. So here we're looking a little bit closer at typical claims that come in, pre-loan, during the loan, in the default responses, any fraud or misrepresentations cases, and breach of fiduciary duties. What we want you to take a loan and think about it holistically from the whole life cycle of the process, and make sure that your policies, procedures, and controls are re-examining these areas to make sure that you have, you know, conservative, good controls implemented in order to eliminate any liability in the future. Next slide, Brad. And here we're going to take a little bit of a deeper dive into policies, procedures, and the guidelines themselves. So as I've been saying, you want to make sure you have a clear set of policies and procedures governing every single silo. Loan monitoring, loan defaults, default cures, special assets and TDRs, independent oversight and controls, various checklists and templates. And what was working in a performing environment may not be as granular as necessary as your default rates rise. If we're anticipating an increase in defaults and anticipating more liability claims and litigation coming on, we want to make sure that we've begun the process of building these policies and procedures out. What we don't want to do is catch up later, because you don't want also behind that wave of litigation will be a wave of regulatory oversight that's looking at the same exact thing. The more resources that you can dedicate to this now, you'll not only starve off the increase in litigation, but also the regulatory scrutiny that will be sure to follow.
And I think, Craig, it's good to kind of, you know, recognize, because this really didn't hit home to us speaking with the bank last week, that, you know, it's been 12 years since we hit, you know, kind of the high point of the recession. And so likely you have a lot of folks in your compliance department, your special assets department, even in your loan ops or lenders, who may not have been working with your institution or another institution 12 years ago now. I mean, there can be some turnover in 12 years. And so the way that in 2007, 2008, you know, a lot of us were playing defense. We had lenders who were very cautious about how they approached particular loans or credits. We had servicing folks who were, you know, up to date on HARP and HAMP modifications. On the consumer side, they had been trained and had ongoing training about what you can say, what you can't say. You know, a lot of that is not something that institutions have been focusing upon in the last 4 or 5 years. And if we continue to have a default cycle develop, we've got to now start moving our training. We've got to move our compliance functions. We've got to move our compliance management systems, testing and monitoring, to really focus on some of these risks that are going to be coming to the forefront. I mean, as Craig was telling that particular client, it's been a long time since we had training for lenders on what you can and can't say. And if something goes bad, how do you avoid making it worse? And this is the kind of thing that we have to start doing now, so that there's not that learning curve where something were to happen in Q4 of 2020, maybe Q1 of 2021, we go through a default cycle, and now you've created this little kernel of liability for your institution that you're then going to have to work your way out of.
It's a great point, Brad. To build off that, we want to make sure, for those that haven't been or managing teams that may be comprised of people that weren't in the industry for more than a decade at this point, you want to make sure that they're not stuck in, well, that's the way we've always done it, this is business as usual. We want to make sure that you're taking your lead in the compliance controls. Even like if you're looking at monitoring testing, you're looking at your risk assessments. Are you interacting with your credit risk groups to make sure that as the credit risk changes, that should be informing your monitoring testing and should be informing your risk assessment. The risk assessments themselves are looking at indicators. Do you have KRIs that are incorporating the possibility of a rising default environment? Those that haven't seen it yet might not be thinking of it, might not be in the forefront. You want to make sure that you're testing for it and you have the ability to locate and escalate it to senior management across the enterprise. And that way you can best prepare for whatever's coming to your particular institution. And with this slide here, we have the loan default timeline. What we're looking at here is warning signs as what it can become increasingly clear that a default wave is coming. You have a sudden drop in earnings or revenue, an increase in accounts receivable, a sudden concentration of large account receivable, a sudden drawdown on open credit lines. Are you looking at those credit lines to see if you want to lower the ceiling bump? A sudden increase in inventory or collateral, questionable valuations presented by borrowers, or your appraisals becoming a little bit more aggressive. Calls regarding activities permitted under the loan documents. Are you monitoring what those calls and inquiries are coming in? If they're not just complaints, are you monitoring the inquiries to see what people are calling in to learn about forbearance activities, to learn about loss mitigation activities? They might not be complaining yet, but the inquiries are still there. A lot of institutions don't have robust reporting coming out of an inquiry line. It's more of a customer complaint program that's just monitoring and reporting out complaint metrics. A sudden lack of communications. The borrower's gone silent. Are they not returning paperwork? Or not returning calls? Are they not in your branches? And this all should drive the management response to the COVID pandemic and the default crisis that's most likely going to evolve out of it. Again, here, I know I mentioned the inquiries, but complaint volume is extremely useful here. You want to use it as the canary in the coal mine that it's supposed to be. Are your hold times increasing for borrowers that are calling in? Are you monitoring hold times? What's the average resolution time on the call? What is the major issue that's being addressed on these calls? It may not be an escalated complaint type, but you want to know what is being talked about in your complaint department to see what is occurring in those business lines. You might want to look at what the definition of an escalated complaint is. Do you want to start looking closer and drill down further into default, see what business lines are experiencing increasing default? You want to get as much information in those metrics reporting out as possible to give it over to senior management, give it to your boards, so that you can start to prepare for what's coming, or be at least secure in your knowledge of what the next quarter will bring. Next slide, Brad. And not only is your controls, the way you document the files, the way you document your operational procedures, good for defending liability, for stamping out, increase in liability, increase in litigation, but it's also going to be required if you come into litigation later. Like you want to prove what the normal course of business would have been, that you were acting as prudent as possible, that you were not negligent, and you were acting in the same manner as your peers, and you can show properly documented policies and procedures. Your the loan file itself is properly documented, or do you have your QA and QC functions looking to see what are in those documents? Are you making sure that the disclosures are properly recorded? Are you making sure that the QA procedures that's done in your first line of defense is robust enough to the point where if you start to see plaintiff's attorneys and borrowers starting to attack the documentation of the file or attack the validity of the file, can you respond to that properly with what's in the collateral file? You want to make sure that those documents are properly retained, properly imaged within your institution, and it won't be a problem to pull down those documents if your litigation increases. You want to make sure that that process is not as manual or as automated as possible in your institution. If you have a great number of outside counsel asking for collateral files, can you get them quickly? Do you have the resources there to pull what's needed that's imaged and get it over to your outside counsel or whoever's defending any cases for you? Next slide, Brad.
And I think one other thing there just to be aware of is training is going to become so critical in the coming months, which is, making sure that anyone in your workout group, special assets, or even the lenders themselves, whether they're consumer or commercial, really understand that, when we see the uptick in lender liability claims or litigation is when we hit the downturn. As everybody's paying and everybody's happy, we don't really see this, but it's very easy to try to be, especially in the wake of the COVID pandemic, very accommodating to borrowers, whether they be commercial borrowers or consumer. But that really can lead to risks for your institution. And just always remember, and this is, we have a whole training series on training for defaults for lenders, is understand what you can and can't say, and always operate off the belief that what you write or what you say could be thrown back in the face of the bank. When you think about it that way, it tends to make everybody act more professionally, because where we saw so many of the problems during the Great Recession is when you saw individuals acting outside of the procedures, trying to, quote, help their friends. And that really led to some concerns. So the more you can train folks now to be prepared for this, I think the better it is on the back end.
Yeah, I can't begin to express how many times I saw in various litigation files, in 2011, 2012, where borrowers were saying, I didn't know that was an option, or I wasn't told that was an option, or I was told that was an option when it wasn't. I pursued that line of loss mitigation for 6 months, worsening my position and eating through whatever equity or limited equity that I had in the secured property. And a lot of the times, the only way to defend that is to say, look, if you didn't have a recording of the call, or it wasn't in the correspondence and it was just verbally said on a phone call, the only thing to point to is the policy, procedure, checklist that you had documented within the organization. So if it's something that's living in your frontline employees' emails or distributed over memos and not documented in your procedures, it's going to be very difficult to defend against those claims when it comes. And when those defaulting borrowers raise those issues in court, the next thing they do is complain to the state AGs. They complain to your regulators, and it immediately shows up in your regulatory exams 6 months later after you see the rise in litigation. Sorry, Brad, back to you for the Paycheck Protection.
Yeah, so we'll shift gears a little bit and talk about some of the PPP litigation, both regulatory litigation as well as some of the class action litigation we've been seeing. And we'll start with good news, and then we'll talk about some of the, I don't want to say bad news, but some of the risks we're going to be looking at going forward as we think about the repercussions of the PPP program. One of the things I always like to put in perspective is understand how quickly PPP was rolled out, how many of you who were involved in this program were working to adapt this over. It was March 25th, 2020. So less than 6 months ago, it'll be 6 months tomorrow, that the PPP loan program was unveiled by the SBA. Imagine now how many small to medium-sized businesses have been impacted by the PPP, how much it's changed our relationships with our commercial borrowers within our institution. And all of that occurred in less than 6 months. Obviously, the offshoot of that is we're still trying to understand as bankers what the offshoots are going to be from PPP. Where are the regulatory risks? Where are the private litigation risks? The first round were these PPP class action lawsuits, either folks challenging who was eligible to receive PPP loans or some of those that were challenging the payment of agent fees, meaning they were an accounting firm, for instance, saying that they should have been entitled to a portion of the fees that were being paid by the SBA for these PPP cases. At one count, there were over 5,000 institutions that had been named in lawsuits across the U.S. related to the payment of PPP agent fees. The good news is, for those of you who may have been caught up in that or who may still be concerned about it, two big dismissals have already been put in place. In August 7th, the first Northern District of California case dismissed those agent fee cases. And then a couple days ago, the Southern District of New York, which obviously is one of the more prominent courts in the U.S., just given their relationship to the financial sector, also dismissed 6 additional cases 2 days ago. We have heard indications that the plaintiffs intend to appeal those up to the next level of court, try to keep these cases alive. But very good developments there if your institution was caught up in some of those PPP agent fee cases. What is perhaps more concerning as we think about risks to your institution and potential litigation is this kind of tail risk with the regulators. We've already seen a lot of fraud investigations related to PPP, where Department of Justice is going after particular borrowers who were involved in the PPP process. More concerning for us as bankers is the potential that the DOJ now pivots and starts looking at the lenders and how they worked with agents and their relationships with borrowers, especially as we've had these kind of changing regimes and changing models for how we're going to process forgiveness for all these borrowers. So it's something that, if you did do a significant PPP program, make sure you really have folks working with you who understand the SBA 7A process that this was built upon, as well as the PPP regs, to make sure your institution's not falling into to some of these traps. On top of that, we also have historically the SBA looking at significant instances of agent fraud. And so if you were working with agents, if you used lender service providers or LSPs as part of your program, if you're going to be using a lender service provider to help process your forgiveness applications, make sure you're working with folks who understand there's an entire section of the standard operating procedures promulgated by the SBA that needs to be followed related to the 7A program. That can be disclosures, that can be filing copies of your LSP agreements with the SBA, certain restrictions on how you can compensate those individuals or organizations with whom you're working, so that you make sure you're not stepping into claims against your institution that may come back to haunt you in the next few months as the SBA starts to investigate instances of fraud, particularly as more and more of these forgiveness applications are processed. The other thing that I think is really important is if we look at how DOJ has prosecuted FHA mortgage fraud, they've actually used it to pursue the lenders based on these theories that the lenders were submitting false certifications to the government. And so understand that, the nice thing is the PPP regulations generally gave institutions, banks, the ability to rely on what the borrowers presented to them. But there is some level of oversight you have to then use when you're reviewing the application, the forgiveness application, and the transactions with that particular borrower. Remember, as part of the certification for the SBA, every institution had to certify that they complied with all applicable lender obligations related to the program. And so anything that's in that 7A standard operating procedure is potentially fair game in a lawsuit by the DOJ on behalf of the SBA against your institution. And so really focus on now, we had to run this out, like I said, less than, 6 months now from the day the thing went live. There's a lot of tail risk you ought to be addressing, whether that's BSA, AML. in terms of documenting how you obtained identifying information on borrowers, information on how you processed applications, how you verified the information the borrowers were submitting, and then in your forgiveness process, how you're prioritizing it, how you're policies and procedures to document how you are processing PPP loan forgiveness. All of that is potential fair game, and you really need to be careful that there's not some tail liability there. One of the interesting things, this was back on September 8th, but it may be a sign of some of the tail risks. We've already heard of some of the large banks that are saying any fees they earned off of PPP, they're going to give over to charitable organizations and others. JP Morgan came out with this statement that the bank has apparently detected some evidence of illegal or unethical conduct related to their CARES Act programs. Understand the DOJ has a whole task force that's focusing upon CARES Act fraud. And so if you're not thinking now that there are potential claims against your institution that may arise based on your handling of these CARES Act programs, just be aware those are there. We had a call with the CFPB, many of you may have been on there, that the American Bankers Association sponsored. And one of the things that the CFPB kept really driving home is they have an entire task force that's looking at institutions specifically focusing on CARES Act programs, whether that be foreclosure moratoriums or some of the consumer loan benefits under the CARES Act or PPP. All of those, they now have a laser focus on those programs, coordinating with other regulatory agencies, really looking at institutions for evidence or instances where those CARES Act programs may not have been rolled out in compliance with the regs or the law.
Another important point.
Go ahead, Greg. I was handed to you.
The other thing I was going to say about that last slide that we were just on with JP Morgan, it's what you want to take away from that too is that they're actively looking. The only way they found that is because they were monitoring and testing, what was going on in that population. They wanted to kind of limit their risk and regulatory enforcement as far out as they possibly could. So they were looking for what they could find, as they're reading the news that's coming in with the fraud allegations, and as they're, contemplating as to what the effects will be of an administration change, if there is one, in regards to their liability with the PPP program. You want to be taking those lessons away from that story and kind of seeing what you can do within your own institutions to mirror that activity in order to limit your not only regulatory liability, but any possible PPP litigation that could arise. And with that, we're flipping over to parallel fair lending concerns. So we have these two bulletins, well, the one bulletin from the OCC and the CFPB blog post from April. The bulletin there is saying from the OCC that the banks are encouraged to collect and track information provided during the application process regarding not only the annual revenue for loans made in the LMI census tracts, distressed areas and undeserved areas, but also how they're benefiting the LMI individuals, the families, and communities. And they are saying, prudent practices, they define what a prudent practice is and what it includes. They're saying it's documenting implementation decisions, such as banks' business justifications and any alternatives considered when setting eligibility criteria, establishing a process for considering applications and approving or denying PPP applications. So the takeaway there is, look, you have to be very cognizant of how you're rolling this program out. Are you rolling it out to, or did you roll it out to just your borrowing population? Did you roll it out publicly? Did you only offer it to a few defaulting customers? Because those decisions are going to be looked at in the 12 to 24 months to come to see if there was any violations there. Heavily focused on any fair lending violations. Did you exclude any borrowing populations that are defined as a protected class under a COA? And then the CFPB came along the very same day and said, hey, just as a reminder, a COA applies to all this activity that you're doing here. Small business owners who believe they were discriminated against were actually encouraged to file a complaint as quickly as possible with the CFPB. That's a strong language, as I can imagine, saying, hey, look, we're already thinking about this. We're going to be thinking about it when we're on site next year with you. So our takeaway should be, we know it's coming. how could we prepare and test for it as prudently as possible in today's environment. Next page, Brad. And here we have the forgiveness application. Brad cut out an actual PDF of it, and it's HMDA style data collection. If you're following the CFPB's push to track, borrowing rates for women and minority small business owners, this is like a treasure trove of information for them. So while they're asking for it to be collected on the forgiveness application, be aware at the same time the CFPB is pushing full steam ahead to make this mandatory going forward. But it would be really responsible of you to take this data in if you're collecting it and start to test it. You want to be as proactive as possible here to see, like, hey, did I have any disparate impact to these protected classes and these minority-owned small businesses, any small businesses owned by the protected classes under a co-op, and think about and kind of discuss what you could be doing in your small business lending that could counteract any finding, any statistical anomalies that you may find. The Bureau and your regulator will look very kindly upon that contemplation and control if you roll it out. Next slide, Ron. And here we have the application data and the data that's been collected thus far. This is across all populations, right, Brad?
That's right, and I think the real takeaway here is very similar to HMDA data that's available publicly. Just understand that as you process your forgiveness applications, or you've already begun your reporting, as you put forward for the guarantees by the SBA, there is a massive database that's sortable by your institution, where all of this information can be obtained about your institution. It's very easy for either the CFPB, your prudential regulator, or candidly a plaintiff's attorney to pull this information and determine exactly how your institution stacks up against peer institutions, how it compares to your communities in which you serve, so your assessment areas. And all of this is now available publicly, and as more and more applications for forgiveness are processed with that HMDA-style data collecting, it's filling out this database more and more. We're not seeing significant disparities yet on those that have been reported. So this is for loans of greater than 150,000, and it compares the relative percentages in the existing PPP data sets versus the U.S. Census Bureau's annual business survey. And so we're not seeing a ton of significant disparities except in some of the race and ethnicity categories. And so as you're thinking about the next few years or next few months, this really is something you ought to be looking at this compared to your existing commercial portfolio, this compared against your communities, and then certainly doing some analysis if there were applicants that you weren't able to process or you declined to see how that's stacking up. Because the short answer is the reason why fair lending claims are always so easy to prove from a disparate impact standpoint is because so much of that data is collected and available publicly. And now all of this is in the public realm. Any attorney or other individual can sort through your institution's data and see exactly what your lending patterns were related to the PPP program.
And what we want to drive home here too is it's a little bit of an odd scenario with the PPP program, given the fact that it's a short window and it's closed. So a lot of institutions may be thinking, well, we were told to do it very quickly. It rolled out very quickly. We were helping the country and getting these funds into these borrowers' hands, and now it's behind us. From a regulatory perspective, it's not behind you. Like the disparate impact in the statistical analysis will be there in a year from now. And to Brad's point, all they have to do is pull the data to see if the anomaly is there, and then you have a disparate impact violation. The only way to combat that is to show that it wasn't a pattern in practice, to show that it was in your policies and procedures to protect against this. It was contemplated in the rollout. You thought about it when you marketed it. If you're past that, you thought about it in the servicing, in the forgiveness. You had controls there in the forgiveness operational function. If you get past that, your next argument is that you did the analysis to see if there was any disparate impact. And if there isn't, you may have missed the opportunity to apply it to a PPP origination, but you didn't miss the opportunity to apply it to your small business lending. And you can take those findings and inform your operations going forward. The only thing you cannot do is have that statistical anomaly found by a regulator or found by a plaintiff's attorney and then be reactionary in your response. You can't say, oh, well, we will test it and we will look at it. Then it becomes even easier to make a successful finding of a pattern or practice for a regulator or for a borrower or a borrower's plaintiff's attorney. Next slide, Ben.
And so now we're going to shift a little bit and talk about this third area that I really see as an emerging risk in 2021 that ought to be on all of our radars as we think about moving forward, and that is this risk of cybersecurity and data breach litigation. We already were seeing a lot of this with big, headline grabbing data breaches related to, credit reporting agencies, related to some of the large financial institutions. But if we look back on what happened through COVID, and I love this slide that J.D. Power put together, some of these charts that show that 82% of consumers are still worried about going into their bank. That means the use of online and mobile technology continues to drive what banking looks like in the next 6 months. And it's across the board. There was a very slow adoption with the greatest generation and the boomers. You saw a lot more adoption of digital streams in the Gen X crowd and younger, but now it's across the board. If anything, COVID has accelerated the digitization of financial services probably 5 or 6 years. In April 2020 alone, FIS saw a 200% increase in mobile banking registrations and an 85% increase in mobile banking traffic. I mean, that's doubling your traffic almost, and tripling the number of new mobile banking registrations. With that, you now have a significant amount of data that's being transferred out to your customers through what may not be a very secure channel or a very secure device. And so, we've seen on one hand this significant increase in how we're dealing with customers, but at the same time, we had to go to a remote workforce. And so you've got something of a combination of two very powerful trends coming together. And that is, a lot of our workforces are now working remotely. They're working out from their homes. They may be in a coffee shop. They may be at a friend's house. Everyone's trying to work remotely. And with that, we've seen massive cyber attacks on those remote work environments. There's been some really important cyber flaws that have been released related to Citrix and Teams and almost all of the major providers of remote work environments. And one of the most troubling is Reposify, which tends to track this, has seen a significant increase in the number of these remote work environments that are just exposed publicly to the internet. And so if your IT folks are not really on top of their game as to these security breaches, these vulnerabilities, all of us are now working from home. All of us are trying to teach children, then try to work remotely from the kitchen, and with that comes significant exposure. And if you're a hacker, there's this one really cool industry in the United States that has not only personal data but a ton of financial data, and that's the banking sector. And so the banks really are the greatest target for cyber intrusions because it is one of the few places that have both personal information on individuals and financial information. If you're able to compromise that, you're really able to get in there and cause a lot of trouble. So we've seen a significant increase in attacks. Just looking at some of those trends in 2020, Google says 350% increase in phishing attacks, 4x daily increase in cyber attacks from FBI's IC3, the Internet Crimes Complaints Center that monitors that. So what we're seeing is just, it is becoming a significant opportunity for hackers to really try to interpose themselves, either by attacking your workforce working remotely or attacking the devices that your customers are using to transact business with your institution. And so you've got it going both ways. And that's what's perhaps most troubling as we look at 2021, is there really is this problem of, if you look here at this next slide, IBM tracks this. average data breach is up to $4 million in expenses to investigate it, attempt to remediate it, pay penalties, pay damages, and do some sort of credit monitoring, other remediation program. What's also interesting to point out here that the Identity Theft Resource Center data shows is if you look at the size of the data breach, the number of data breaches is remaining somewhat constant, the light blue columns, if you will. The individuals impacted continues to go down. So if you think about what that's showing us is more and more hackers are targeting smaller institutions. As the spend from the JP Morgans, the Wells, the B of A's of the world continues to go up, they become much more difficult targets. But smaller institutions, smaller businesses, those commercial customers to your bank become much more attractive targets. And we're seeing that play out here in the data breach trends, which is same number of breaches, fewer individuals impacted because they're targeting smaller institutions, while the price of a data breach continues to escalate. And that's not counting the lawsuits that will come about as a result of that. Not only do you have that risk of lawsuit, but you also clearly have a reputational risk as you're now relying more and more on the comfort of your customers to work in that remote environment. And so as you continue to drive that mobile and online usage, which is how we can still continue to grow as institutions, because we can't simply put more people in branches and hope more and more people come to brick and mortar. You've got to instill that confidence inside of your online and mobile banking systems so that that stays intact. And that same issue comes about here, which is look at these headlines and imagine if one of these is your institution. The last thing you want is to be on the cover of American Banker or be on the cover of the Wall Street Journal where you're being called out and focused upon because you were the subject of a data breach. Same thing here, where these institutions are having to suffer through class actions, press releases, all of these concerns that are occurring as a result of these challenges we have in this remote work environment. So if you're not doing it now, really make sure that you are focusing upon the potential risks that arise as a result of this perfect storm that's occurring.
One thing I want to say about
yeah, go ahead,
Brad. To Brad's point of a perfect storm, the landscape today looks so radically different than it did in December of 19 or January, February of this year, when most likely your controls groups were defining your known risk indicators or your risk assessment criteria or your risk assessment ratings for 2020. And, it's been such a turbulent year with, moving your workforce to remote or, driving online or remote functionality to your consumers. You want to make sure that's all reflected in the risk assessments that you defined before this all began. You want to make sure that you can show how that was, shifting and you were putting adequate resources to the rising risks and you were aware that that's out there. That will go a long way in defending any litigation and defending any regulatory inquiries that pop up in the next 6-12 months.
Yeah, great point there, Craig. And the last topic we're going to cover is merger litigation. Anytime you have significant economic shifts, either for better or for worse, you're going to continue to see M&A activity. I mean, we've got a macro trend already as fewer and fewer de novo institutions are being formed. So there's much more of a focus on the merger of different institutions. And, we really don't see that changing. If you look at the far left chart, this is the latest FDIC release that goes through July of 2020. The number of mergers has remained relatively constant. The number of failures has remained relatively constant. And the number of new institutions that are being formed remains extremely low, with only 1, 2, never more than 5 being formed in any quarter. So we don't think a bunch of de novos are going to start chunking out of the gate. At the same time, we continue to see significant merger activity, and there's so far no sign of that slowing. But what we do need to realize is there's also these broader factors. And I love pulling some of this data in as we try to look into our crystal ball, look into the future as to what may be economic forces driving the banking sector. And I think one that obviously all of us as bankers, as well as our boards, are focused on is when we look at what our income is and our interest margins. If you look at that bottom graph, that's quarterly net income for all reporting institutions to the FDIC. And you see that precipice that occurred at the end of 2019 as we moved into Q1 of 2020, where generally securities and other gains and losses stayed relatively flat. But what we saw is net operating income dropping by almost 3/4, so a massive hit. And what may be driving a lot of that is some of these net interest margins that we're seeing as rates continue to come down. There's not a lot of money to be made right now within traditional lending environments. And it's particularly hitting large institutions, those with assets greater than $1 billion. We've seen some stability in the smaller financial institutions, those under $1 billion in assets. But at the same time, all of us are experiencing these concerns or these shocks about the net interest margin. If anything, we would expect the impact on the less than $1 billion institution to kind of trail what's happening with the larger institutions, the red line that you see there. And then when the FDIC looks at it and says, okay, what's really affecting earnings? What's happening when we look at 2019 versus 2020? There's one big glaring problem on this graph. And that is, just like we talked about, significant decrease in net interest income. We're having a hard time making money off of lending. And at the same time, we're reserving for these credit losses. Hopefully we can start to bring that large upward graph down. And as we cycle out of this environment, we'll have to have less losses reserved inside of our portfolios. But I don't know that in the near term, you're going to see a significant increase in that net interest income. And so with that continues to then be a real focus on M&A activity, ways to grow institutions, try to consolidate costs and expenses through merger. Interestingly, with all of that M&A activity, or I should say with that staying relatively stable, we still see significant numbers of securities lawsuits that are still floating around. It's dropped off a little bit in 2020. That may be as a result of, a kind of macro slowdown in M&A activity as people were trying to, in essence, pause, figure out what the markets were going to do, where they wanted to be in terms of looking at M&A activity. But at the same time, the number of lawsuits compared to what we've seen in the larger economy still remains high. We still see significant pre- and post-closing merger strike suits. It's becoming less and less of a focus on the pre-closing lawsuits as more and more folks are comfortable with, quote, giving the cold shoulder to a plaintiff's attorney who's threatening to derail a merger. And part of that also is a little bit of an offshoot, particularly in Delaware, of the Court of Chancery. They're making it more difficult for individuals to fight mergers or delay those mergers. But we still see in almost every merger at least some threat of a lawsuit. Now, how you respond to it, varies based on your particular circumstances, but generally in the event of a merger, you're going to have someone threaten to sue you. And it used to be that the threat was, I will delay your merger. I can make this nasty. I'll keep fighting you over disclosures and materiality. And if not, you're not going to close. So you need to do some sort of change to the disclosure. And oftentimes that was somewhat pretextual, but there would be some sort of change that was requested. And then generally you paid the attorneys a big fee. Delaware, as well as other jurisdictions, have tried to crack down on that, make it less of a easy payoff. And we tend to see the same people doing it over and over again. And so, there's been a lot of pushback within the court system to try to fight these particular shakedown lawsuits. But just so you know, we did an informal poll of our clients. We said, how many folks, when you're planning M&A activity, are building in some amount to pay off these attorneys? And almost 100% of those institutions responded that they expect there to be some sort of shakedown. Now, whether you actually pay it or not is one thing, but they almost universally expect there to be some attempt at a shakedown as soon as that merger is announced. And so I think most of us are still building in some likelihood that some amount gets paid. Yeah, the real interesting thing is, excuse me, there's been a real change in the focus from not only the pre-merger, I'm going to block your merger claims, to post-merger. And yeah, there's all sorts of theories as to why this happens. But one is there's less law that's developed, so the likelihood that a court shuts down the post-closing merger suits is probably lower because there's less law out there to stop it. But then there's also, something to be aware of, which is that the plaintiff's attorneys realize that they can stop the merger activity. Suddenly, the acquirers, executives are having to go and give depositions, engage in discovery. They've realized there's value because oftentimes those claims are not going to be covered by the target, the non-existent entity's D&O policy that didn't survive the closing. And generally, they want to just make it, something where the dirty laundry is being put into the public. Look at how they valued this company. Here's all the horrible things they didn't disclose to shareholders, and they think there's going to be value in the perception of the acquiring institution. And there's all sorts of theories about whether these are their own lawsuits or these are actually trying to re-energize the pre-merger lawsuits. Because so many people were ignoring the pre-merger lawsuits, and the idea is, the whole concept of, well, once I close, the market's going to correct itself. The idea here is that I can tie you up in litigation, just make it a problem for the acquirer for months or years after the merger closes. And so just be aware that, we continue to see this shift and we don't see it going away in the near term. So as you're thinking about potential M&A activity, a few things just to really be aware of is make sure you understand that there is a high likelihood someone's going to raise something. And involve your consultants and your counsel early in every step of that process so that you're really understanding exactly what the duties of your board is, what the duties of your management team will be as part of that merger process, and that you're checking all the boxes. You're really handling those disclosures, how you articulate it in a very thoughtful and controlled way, because there's almost 100% chance that some issue is going to be raised. As you consider those merger opportunities. And then really think about being strategic as you consider M&A activity. And what we mean when we say that, and I think Neil Grayson and Brennan Ryan, two of our M&A attorneys in the banking practice, really put this in perspective well, and that is the time to figure out what could go wrong is not during the merger or during the merger negotiations. You need to be planning 6 months to a year ahead. And so if we're thinking about, again, if there's one thing you take away today, it's timing, timing, timing. We know banking is changing. We know the economy is changing. And we know that M&A activity is likely to shift in some way in 2021. If you're not thinking about it now, you're behind the ball. And so really be thinking strategically about those opportunities as well as those risks right now while there's a time for you to do something about it. With that, we'll close out. We've bumped up against the top of the hour. If anyone does have any questions, feel free to shoot those in or feel free to email either of us. We're always glad to respond to your questions. We'll continue, obviously, next 2 weeks from now with our next In the Trenches series. We hope you're enjoying it. If you have ideas for additional In the Trenches webinars or topics you'd like to see us address, feel free to email those in to us. We love your feedback. We love your ideas. As we continue to try to be a resource to you and our clients, and as you navigate a very difficult time, both presently and in the coming months. Most importantly, we just want to say thank you. We know how challenging things are right now for financial institutions, and it's truly because of your efforts and your team's efforts that things are going as well as they are right now. And we're keeping businesses open. We're keeping liquidity in the economy. And so thank you for all of your work. And as I say, reach out to us anytime. We'd love to hear from you. Craig, any final thoughts?
No, that's everything. Thank you very much, guys.
Great. Well, thanks everybody. Have a great rest of the day, and we look forward to seeing you during our next In the Trenches presentation.